The following is an update and technical analysis on crude oil, West Texas Intermediate futures based upon the daily interval. And crude oil is now within a very peculiar technical posture and stance, backtesting off the primary reactionary uptrend line off the March 2023 major reactionary lows. And I had talked about in that previous video, the ton of major reactionary lows and now highs were a crucial element to that key technical posture, where you had the 71.88 price resistance and 72.62 price resistance hovering up above, and looks like we may have just tagged that ever so slightly there, and that has been rejected thus far. If you have continued to follow some of these key levels here, with crude oil now facing a physical shortage crisis, where the API crude draws 9 out of the past 10 weeks as Cushing hits tank bottoms, we are witnessing an unprecedented divergence between the physical and paper oil markets, where Goldman analyst Julia Grigsby highlighted this divergence, where Brent crude's price continued its slide here, really to the December 2021 levels, triggered by macroeconomic events like the disappointing U.S. jobs report, where while financial markets appear to be in turmoil, the physical demand for oil remains resilient, potentially tightening within the API and some of the crude oil inventory data, where despite some of these bearish headlines, our trackable net supply dropped thanks to lower production from Russia and Canada and a moderate recovery in China's demand. The paper oil markets still crashing by a staggering 7 million barrels per day over the past 2 months here, which could have been technically induced off that primary reactionary downtrend line off the top of the primary megaphone. And that is the kicker. Physical markets are tightening, but the paper market is caught within a doom spiral here off this beautiful, which I have now a renewed primary reactionary secondary downtrend line here that has had some key additional reaction, where the critical point, a situation where accessible physical oil vanishes and those record shorts in the paper market could face a brutal reality check, where the reverse of what happened in April 2020 during the COVID lockdowns, when excess oil sent prices within the negative realm. The API completely confirmed it, where Cushing stocks plunged by 2.6 million barrels, the biggest weekly drain since August of 2023. We are now staring at tank bottoms, could send prices skyrocketing, where a short squeeze of epic proportions could be looming. And for now, let the bears celebrate their hollow victory off the bearish megaphone pattern, where oil has been artificially depressed to serve a potential political narrative. The truth is, this cannot hold forever. When it cracks, the eruption will be one for the ages. Long traders, bull traders, they want to see a recovery of the 70.67 price support level and ultimately taking out the secondary primary downtrend line. Make no mistake about it, there is a ton of resistance up above in correlation of the primary reactionary uptrend line and major price resistance levels. You have your 50-day moving average hovering in up above. On a confirmed death cross bearish continuation pattern, you have an additional primary reactionary downtrend line off the megaphone pattern. There's just a plethora of resistance up above. Long traders, bull traders, they want to see a solid infused big breakout candle above all key, call it a triple transitioning price resistance level, to go on to scare off and panic off some short selling, to go hone in on for that next target up above, challenging the primary reactionary downtrend line, ultimately taking that level out to go on to re-challenge the weekly price resistance level of 77.22 price resistance and the 200-day moving average hovering up above, call it a dual line of price resistance, which would accelerate a short squeeze if completely violated. On a remainder, big move to the upside, challenging the 80.20 price resistance level and the top of the triangle primary reactionary downtrend line resistance. That will be the biggest telling point if and when long traders and or bull traders are able to make it up on that big short squeeze move to the upside, where the bottom was initially called at the 66.89 price support level, called the weekly, and 67.26 daily price support level. Big key level there, with a ton of stop rates to go off, completely pulled down here, zapped a whole bunch of stops, down 3% on that key inflection point, not knocking the 5% risk reward ratio realm, and that was bid heavily to the upside, back testing and reflecting off some of these key inflection points. Short sellers, they want to see a continuation off this rejection, the primary reactionary downtrend line and secondary downtrend resistance. And that has been reflected really to the button there, right off the 72.62 handle. And that was so far, especially for an active and or day trader, has netted you for a significant move to the downside, call it a 4.3% drop, with potential for a move even quicker down to retest its 67.26 price support level. And the weekly, monthly, interval 66.89 price support level. Short sellers want to see that level go on to retest those previous reactionary lows, and that would spell for a ton of stops to go off, margin calls, you name it, on a retest of the big monthly price support level of 64.59 price support. And that will be the last line in the sand for additional, much larger, bigger drop to come. And so we stand on the edge of a seismic shift here within the crude oil markets, or a moment where reality confronts illusion. The bears and short sellers may revel now, or the narratives may echo loudly, but the truth has a way of breaking through. As Cushing's tanks hit bottom and the paper market's delusion meets the hard wall of physical scarcity, one thing is certain, where this game can only be played for so long before the floodgates open. When that moment arrives, it won't be just a shift. It will be a reckoning where prices will erupt, shorts will scramble, and the market will bend to a force it could no longer ignore. Where I will personally be waiting for a potential divergent low on a backtest and retest of the 64.59 price level. And that would be a very unique and telling point if and when we could raid some of those stops to go off, crack that price support level, ultimately issuing in a nice bounce target at the 64.50 handle for a nice confirmed divergent low. You'll have confirmed bullish divergences within multiple momentum indicators, and that would be the precipice for a technically induced catalyst where the headlines follow the charts and the technicals to the highest order.